unless you've spent the last year in the metaverse with a virtual reality headset on the entire time, and maybe you're trying to keep up with the Kardashians instead of what's actually happening, then you probably missed the Federal Reserve and their activities. But in this video, I'll give you the updates on what's happening right now and what that means for you. You came here for the truth, so let me unveil that for you. I'm going to show you some information that is going to highlight what's happening in this current system as it relates to you, the individual, the saver, the person who works hard every day and wants to know what's happening with their hard-earned cash. So let's show you right now. In this, we begin. Flight to money funds is adding to the strains on small banks. So a lot of people are taking their money out and they are putting that into different places, including money market funds. Money market funds are simply like cash. Think of them equivalent to cash. A lot of these mutual fund companies, big fund companies, they have these money market funds that generally do see a lot of investment, but right now more than ever before, as people are pulling their money out of particularly the smaller banks and just want to park it somewhere for now until they figure out what to do. And that's putting some real big strain. And we saw that with SVB, okay? Silicon Valley Bank's collapse has caused savers to seek out alternatives, but the shift poses risk to the financial system with the wider economy in that as well, of course, because what happened, as I've said 100 times before, but they just really explain it well in this Bloomberg article, is simply that they increased interest rates. And for a lot of these companies, they had been buying these different assets that were long-term, but the deposits are considered short-term. And that's a mismatch. That's okay as long as a whole bunch of people don't want their money out. And so it could happen to any bank. The question is, do people feel more concerned about SVB or jpmorgan or Bank of America and Citibank and all these different things? That's the question. And so you can see it right here. I think it is an issue that could affect any bank, but at this time, we had seen, generally with the smaller banks, it just happened to hit SVB really hard, really fast. The turmoil underscored that there are other places people and companies can park their spare cash and get a better interest rate. Over the past few weeks, it's been a slow flight from low yield savings accounts have become turbocharged sprint to high earning alternatives. So people are saying, hey, I could put it into somewhere and earn a few percent. It was earning nothing before. Now I can start earning 2%, 3%, 4, 5%, depending on the account. Now, it just so happened to be that SVB and I think it was Signature, they were offering some of the highest rates. So you could see that their deposits, on one hand, they're bringing that money in, that's short term, but they had to earn a lot of interest to be able to pay that back to the actual person who, is expecting that interest rate. How do you do that? Well, that's why they took such a big loss, because they can't, figure out a way to get that return. How are they going to get 5%? If they're, actually advertising 5% out, it would have to be like a Ponzi scheme. And that's what happened here. It collapsed. They're not the only bank that's doing that. And that's why I believe in the previous video, the one before that, Nouriel Roubini said most of the banks are near or completely insolvent. And that doesn't show up in the paperwork. Like, you're not going to see that out there. They're not going to admit that. But that's like financially the way that it would be if you're running your own company and you had to manage your own paperwork and you had to write everything down and put it all in the spreadsheets. It would show that you are insolvent. These banks, though, different rules for them, of course. Isn't that how it works? Let me show you some more. Community Bank CEO, Congress must raise the bank deposit insurance limit to $10 million. I would say that's not even necessary, but the point here is that they want to ensure that the bank runs stop. Hey, we're getting killed out here, make it stop. So if they just put it way, way higher, then okay, everyone's all good. I don't think, this is my personal opinion, people shouldn't have their savings in cash like they do. Like, why are you keeping millions of dollars in a cash account? That just doesn't seem wise to me. Why wouldn't it be in an asset? I know you want to park money on the side, but all in one account, all in two accounts, like that's That's not wise at all. It just doesn't really make any sense unless somehow they received, like they sold their company and now they're just sitting on a big pile of cash. They don't know what to do with it. I don't know if, how many people that could really apply to. But anyway, in this case here, you're just seeing it as being part of the cycle. This is the truth. Fed cut may be too late to ease stress on debt-laden firms. Strategists position for further pain as banks rein in lending, utility and healthcare shares, and investment-grade bonds are favored during these times. Restrictive, constrictive in terms of the financial conditions. And so a lot of investors are saying, hey, now is not the right time to take that excessive risk and all this. I think personally, for what I have seen, is that there really is no fear. VIX index is looking super low, measuring the volatility in the stock market. It is a fact, though, that a lot of investors have moved into simply the biggest names. So all this new capital that they have, they've been putting that into the Microsofts and the Apples because they say, hey, those are the big boys. But right now, the vast majority of the market is made up of just a handful of names. That's not very good. We want to see wide breadth. Like, think of it, like if there's a lot of appetite for a lot of different stocks in a lot of different sectors, that means it's healthy. But if it's only a few names, that's not healthy at all. And that's why you have investors that are, Warren Buffett's and so on, who say, you know what, I'd rather hold on to some of these treasuries and things instead of buying into stock market. And that's been years. He does occasionally buy in, but they're not seeing that opportunity there because look at it. Look at how expensive everything still is, still today. Even when the valuations came down through, whether it was 2022, 2020, it didn't even reach near fair value at all. It's crazy, but that's what quantitative easing will do. It creates distortions, and of course, they want that again. Investors are rooting for that, and that's so dangerous because your currency is being devalued. You keep money at the bank each and every day. Not only do you live in the fear of, is it going to be a bail-in? What's going to happen? Am I going to be able to take my money out tomorrow? But at the same time, inflation is eating away at that. Like, think about how crazy that is, that you got to go and sidestep all of this. You're like a running back on the field and you're, dancing around trying to get to the touchdown zone for something simple like your own savings. You work so hard for this and there's these things attacking you from all angles. That's the way this works. Crazy, but that's the case. In Europe, Christine Lagarde says core inflation is still significantly too high. So that means they need to keep interest rates higher. I really have said that 1,000 times. I'll say it again. That Europe is positioned terribly. For me, I am one of the things that I'm trying to expand into Europe. And when I do this for my e-commerce, like the amount of paperwork and red tape and nonsense that you got to go through, that's one thing. It's just the bureaucracy is terrible there. But at the same time, it's just getting anything done is bad in Europe. My experience, that's just the end of that. But this is what we have. And then, the economy is going to be essentially stifled while we have high inflation and high interest rates. Because keeping them super low for super long wasn't helpful to them. It didn't work. And now raising them, it's just crushing them because they haven't fixed any of their fundamental problems. Okay, that's the issue. Now, the next thing we're going to be talking about here is looking at what's happening with the banking fears, looking at the stock market volatility, and Goldman Sachs even saying it's time to buy the dip, but in what asset? What do you think? Well, let me show you. Here we go. Like a meme stock. Okay, what are we saying here? Another worrisome development is the extreme volatility in the short-term government bonds that we have noticed. Of course, the market went crazy. You were seeing very short-term debt giving you 5%, which is, only back in 2007 we saw that. And now what they're saying is when the 2-year treasury yield starts acting like a meme stock, you know you got some problems. The bond market is saying, yeah, you're going to raise rates, but it's going to be a mistake, and then you're going to be cutting in the not too distant future. And that's exactly what I've been talking about, how the market has priced this in already, that they're saying, yeah, whatever they do doesn't really matter, but in the near future, they're going to be cutting rates. So let's just go with that. Even if the market comes down 10%, who cares? Because we're going to be able to take advantage of this. Crazy, crazy time that we're living through right here. Crude oil prices are on their way up despite the market panic caused by the collapse of two banks. The global head of commodities of Goldman Sachs said, "We would argue that you are buying the dip at this point. I have never seen a market sell off that sharply but retain its bullish structure." So Goldman Sachs is saying buy the dip in oil. One of the factors, the reasons why, is growth in China. Shut down for 3 years, reopening, here we go. That's what many others have said too, but that's what they say, and I bring it to you. Now, how can we trust Goldman Sachs? We don't have to trust Goldman Sachs. Understand that despite the fact that this is, a company, I mean, my goodness, I could go on all day about Goldman Sachs, but their reports, you see, they are selling to investors and they are dealing with a lot of clients that rely on their information for buying and selling. So if they're not going to give them good information, they would then not use their services anymore, and then it would be a problem. So there's like the two sides of it. So the reports could actually be accurate. You take it with a grain of salt. And then there's like the corporate structure of Goldman Sachs, to how they're in and out, revolving door with government. Okay, that's all bad stuff. All right, and then there's this, like I couldn't believe it. You might have seen this being passed through social media, but it's one to keep an eye on, and I'm gonna leave a link in the description under the sources as always. This is a chart that the creator of this was like literally back in the 1800s, and the chart tells investors to sell in 2007, just before the financial crisis. It also says that 2023 will be a year of low prices when investors should buy and hold, which, given last year's sharp share price falls, complies with the logic of selling high and buying low. Periods when to make money. Just look at that. And it's very accurate. I mean, remember, 1800s this chart was created in. And it just goes through a few cycles. And you could see here, he saw his assets wiped out in the panic of 1873, identified an 11-year cycle in corn and hog prices, as well as the 27-year cycle in the price of pig iron. Now, this is old school stuff, but look how accurate this could be. And I just wanted to share with you. And we can look at that and see for ourselves. It's just something to see and something to take note of. But I'll leave it there if you want to pause the screen or check the sources in the description. These are the things that we have today. There's a lot of turmoil, a lot of crisis, but you got to protect your money and you got to worry about what's happening with the Federal Reserve. I've said this 100 times before. Pillars of prosperity, really important stuff, because it's not just about earning more income, making more money, maximum price appreciation on your stocks, your Tesla stock. It's also about preparation and self-sufficiency. These things you can't get around. You can hide, right? You can try, but ultimately we've got to be prepared. That's the message of the day. Are you an insider? If you are not, I mean, first of all, why? But in the second thing is, you got to get on there. It's totally free. I'm paying, I think, what, 150 bucks a month or something to make this happen. And I hope that you would take advantage of it, because or else I got to make it go away. And that is the video of the day to your inbox, directly to you. Each and every day. I got suspended now on my second suspension, not even sure why, but who knows, suspended again, second time. Apparently they don't like my emails, I guess. But anyway, the point here is that you've got to get on the insiders right here at this thing, or themoneygps.com. Scroll down to the bottom, fill in your email address, and I'll send the video of the day directly to you. Take care.